In Australia, your superannuation is tax-free once you retire. To the IRS, that promise means almost nothing. The US-Australia tax treaty was signed a decade before compulsory super even existed. So, as far as the IRS is concerned, your super isn't a retirement account at all. It's a foreign trust, and depending on how the trust gets classified, you could owe US tax on growth you haven't even touched yet. In this video, I'll show you exactly how the IRS classifies your super, what that means for your reporting obligations, and the specific traps, contribution limits, rollovers, payouts that catch even careful taxpayers out. Quick context. I'm a CPA here in Australia and an enrolled agent in the US. This video is general education on how super is treated for US tax purposes. This is not personal tax advice. I don't know your specific fund or facts, so nothing here should be treated as advice you can act on directly. Here's the root of the whole problem. The US Australia Tax Treaty was signed in 1982. Compulsory super didn't exist until 1992. The treaty was never updated to deal with it. So there's no clause that automatically shields your super from US tax the way there is for pensions in some other countries. On top of that, the treaty has a saving clause, which lets the US keep taxing its citizens on worldwide income as if the treaty didn't exist. Some practitioners argue the compulsory super guarantee should be treated like Social Security under Article 18, but the IRS has never officially ruled on that. Don't file on the assumption that it applies to you. Here's the single biggest fork in how your super gets taxed, and it comes down to one number. What percentage of your balance came from your own voluntary contributions versus your employer? If your fund is professionally managed and your employer's contributions dominate, it's generally treated as employee benefits trust. Growth stays deferred, similar in spirit to a 401k until you're paid out. But if your personal contributions, concessional or non-concessional contributions, cross 50% of the total balance, or you direct your own investments through something like an SMSF, the IRS treats it as a foreign grantor trust instead. And a foreign grantor trust has no deferral at all. Every dollar of growth, realized or not, gets taxed on your US return every single year. That 50% line is the trap. Voluntary contributions that feel harmless in Australia, like salary sacrifice, personal super contributions, extra deposits, can tip your fund from deferred to fully taxable without you ever realizing it happened. So, control and contribution ratio decide your classification, and your classification decides whether growth is deferred or taxed annually. Now, here's what you actually have to report, regardless of which side of that line you're on. Three separate reporting systems can apply to the same super account, and filing one does not mean you have covered the others. Foreign bank account reporting applies once your combined foreign accounts, including super, exceed 10,000 US dollars at any point in the year. Most practitioners treat super as reportable here, especially once you have a real financial interest in the account. Don't assume it's exempt. Form 8938 is separate, with separate thresholds. For example, over 200,000 at year-end or 300,000 at any point during the year if you're single and living abroad. Roughly double that if you're filing jointly. This is a different system, filed with your tax return, not through FinCEN. And if your fund is classified as a foreign grantor trust, remember that 50% line? Forms 3520 and 3520A can come into play too. Some retirement arrangements get relief from this under IRS guidance, but don't assume that your fund automatically qualifies, especially if it's an SMSF. Three more traps worth knowing before you assume you're in the clear. First, even employee benefits trusts aren't automatically safe. If your fund fails certain US non-discrimination tests, which most standard Australian retail and industry funds do, and you are a highly compensated employee, currently around 160,000 US dollars or more, you lose the deferral and get taxed on your fund's growth every year anyway. Second, retirement withdrawals. In Australia, they're tax-free at 60. The US taxes them anyway, as ordinary income under annuity rules. And because Australia charges you nothing, there's no foreign tax credit to offset the US bill. That mismatch is one of the most common double taxation surprises in this entire topic. Third, rollovers. Consolidating funds is a non event in Australia. But unless your fund is already a foreign grantor trust, the IRS can treat a rollover as a fully taxable distribution of your entire balance in that year, which can push you into a much higher tax bracket without a single dollar actually reaching your bank account. Two things I haven't covered here on purpose. If your super holds managed funds or ETFs, those investments can trigger PFIC reporting, some of the most punishing rules in the entire US tax code. And if you also own an Australian company, there's a separate trap tied to a one-time transition tax. Both will get their own full video. Subscribe so you don't miss them. Remember how we started. A super balance that feels tax-free can still create a US tax bill, and it comes down to how your fund is classified. I put together a free super classification checklist to help you work out which side of that 50% line you're likely on and which forms are likely applied to you. Link in the description. If you want a written determination for your specific fund, I offer a fixed fee superannuation classification review. It's not a full return preparation engagement, just a clear answer on where you stand based on the information and documents you will provide so you know what you're actually dealing with before you decide your next step. Tax free in Australia doesn't mean a tax free to the IRS. But knowing exactly where your fund sits is what makes it manageable.